bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the February 6th, 2024 podcast. On January 1st, just over a month ago, many provisions of the Housing Opportunity Through Modernization Act became effective. Now, you may know of the Housing Opportunity Through Modernization Act by the acronym HOTMA. HOTMA was signed into law nearly 8 years ago by President Barack Obama, but it has taken this long for the final rule that implements the HOTMA sections that we're going to discuss today to become effective. Now, these HOTMA changes that we're going to discuss today affect every rental property financed by low-income housing tax credit equity. Let me say that again. These HOTMA changes we're going to discuss today affect every rental property financed by low-income housing tax credit equity. And if that doesn't get your attention, I don't think anything I say can. Now, those of you who are watching on YouTube can see, and those of you who are listening and heard a little giggle, I'm joined today by Stephanie Naquin, Novogradac's Director of Multifamily Property Compliance. Now, the final HOTMA rule changes many of the ways in which tenant income is calculated for tax credit properties, as well as how tenant income is verified, which is why we have Stephanie back on the podcast. As you're going to hear today, affordable rental housing property owners and managers will need to update many of their property management compliance practices. Emphasis on will need to, not may need to. Some of the more critical property compliance HOTMA changes are also the topic of my column in this month's issue of the Novogradac Journal of Tax Credits. There's also an article in the same issue by Stephanie. I will share a link to those articles in today's show notes. Now, given all these changes, there's a lot of information for us to cover today. So if you're ready, let's get started. Stephanie, welcome back to Tax Credit Tuesday.
Hi, thanks for having me back. It's like on your opening, every time you do everything, I want to go dun dun dun. Like I said, like an episode like Law and Order, it's like Tax Credit Tuesday, dun dun.
There you go. We'll see if we can license that. So before we get started talking about HOTMA, please share with our audience what you do at Novogradac, what services you provide to Novogradac clients.
Ooh, well, let's just acknowledge it on the on front. I'm not an accountant. I am all about things multifamily compliance. And so in that capacity, we do a whole bunch of stuff. I have a big, robust team, and we do tenant file reviews for investor syndicator audit. We act as owner and third-party management kind of compliance department, where we do oversight of tenant file compliance consulting, portfolio oversight. And then I get to do the fun stuff where I consult with owners. I help folks navigate their way out of non-compliance events. I consult with HFAs and syndicators. I get to do fun things like the podcast and write journal articles. So we really do quite a bit. I only play a CPA on TV where people ask me like how something related to non-compliance may affect a credit delivery. And I'm like, I'll tell you the concept. I won't tell you how to calculate it. So I like to think of what I do with Novogradac as holistic compliance, being able to offer from A to Z compliance support, whether that be answering questions to helping develop policies and procedures, to reviewing your tenant file, to helping set national standards.
Great. Thank you for that. And you're also at lots of our conferences. So folks want to meet Stephanie in person, please come to one of our conferences. Now, in the introduction, I talked about how the HOTMA changes affect every tax credit rental property. I emphasize that, which generated your giggle. Please give the audience an overview of what the HOTMA final regulations cover and what listeners and viewers need to know in a very broad sense. And then obviously, in the course of the podcast, we'll get into the details.
Right. Yeah. So I think it's important to set levels, like what HOTMA is, right? And so HOTMA, like Mike, you were saying, we took it signed into law a bazillion years ago, and it's taken a long time for it to be actually published. And now it's in effect. And so in January of 2023, it was actually integrated into the publications. And we received an implementation notice in October, late September, early October of 2023. And effectively, what it does is that it changes the base Code of Federal Regulations, so the CFR that covers all things related to Section 8. So if we think about what that means, it's just 24 CFR Part 5, commonly known as the Part 5 definition, which is all things under the Housing Act of 1937. And through that, it impacts a lot of different HUD-specific programs. And so if we think about HUD as an organization, right, there's three branches from a practical perspective. We have public and Indian housing, that's our housing authorities, and they operate kind of one line of housing under HUD. And then we have multifamily housing, which operates kind of another line. And then we, of course, have CPD, Community Planning Division, and that's like Home, National Housing Trust Fund. And each one of these various kind of branches or divisions of HUD is impacted by the HOTMA guidance broadly. So you're like, why are we talking about HOTMA then if this is a LIHTC discussion? As we know, when Congress created the LIHTC program way back in 1986, they wisely looked around and said, hey, what's already going on? Let's not reinvent the wheel and adopt current standards for the purposes of eligibility of our program, Section 42. And so because of that, we calculate income in a manner consistent with the Housing Act of 1937. And since that has fundamentally changed through HOTMA, by extension, what we do has fundamentally changed. And so that's why we're talking about it and why it was such a huge deal. I've been doing this for a long time. Like I was trying to think back and it's been like 20 years. And for all you guys asking, yes, I did start in this industry when I was 10. I'm just kidding. But I've seen a lot of different changes throughout time, and they've been substantive in the sense that they affect what we've done, but they haven't been sweeping in the same capacity. And so this is really the first time in my experience that I've seen such inherently sweeping changes that touch all things related. And so HOTMA changes a bunch of stuff for all those other branches under HUD. Things like interim certifications, things like asset limitations to live in a HUD-funded property, things like how to calculate rental assistance, things like reporting requirements and software and mechanisms. And because of that inherent change and the lack of kind of getting systems online for those specific HUD programs, we've seen a little bit of delays and flexibility in the way we comply, but from a Treasury perspective, it's in effect. Federally, the law has changed for the 24 CFR Part 5, specifically the part about income and assets, which means it's in effect now. And that's why we're talking about it in this moment. And really after it's already in effect is what we're talking about. Like if you're a property manager and you're thinking about like, how does HOTMA impact me? I want everyone to remember we're already operating the Section 42 circle to the HUD square. It fits, it doesn't always fit, hasn't always fit, fits. And so we need to remember the structure of the program as we have these conversations and identify those particular provisions under HOTMA that directly impact eligibility under the LIHTC program. Because when we start muddling these kind of things together, it can get a little bit confusing. So I'm really happy to be here today, Mike, to really focus and hone in on of all of those hundreds of pages of the implementation of this and all that crazy legal language in the law itself, how do we get through all that noise and identify what do I need to know to be successful with these new regulations?
And when we were preparing for the podcast, we talked about two major sections, Section 102 and Section 104.
Mm-hmm.
Can you describe briefly those two sections? Then we can unpack 102 and 104.
Yeah, so 102 primarily tweaked a little bit to some extent the definition of income as we think about it today. And Section 104 really talked about the changes in our consideration of assets. And so when we look at those, Section 102 and Section 104 together, it gives us an understanding of how they work together for Section 42 and what our responsibilities are for implementing those.
Great. Thank you for that. And the 102 deals with things like student financial aid, or alimony, things of that nature. And 104 deals with the imputation of income on assets. So let's start with 102.
Yeah, but just real quick, before we jump into this, for
Please.
like all the practical listeners out there that are doing this day to day, I do just want to, on the onset, acknowledge the implementation notice muddles it all together in the sense of you have income and then obviously you have assets and there's income from assets. And then separately, what are assets and how do you value assets a little bit. But when we are looking at a household or an applicant's eligibility, we're really looking and screening for what are our sources of income and then what are the assets that are on the table for this applicant and then verifying them and then putting them together at the back end to figure out how they play with each other. And so we're going to really look at this very technically from the various sections and roll through it. But I want everyone out there to know it's all together in determining is a household income eligible, even though that's like income and assets and income from assets and all those various words.
No, I appreciate that way in which you frame that. That's a good way to describe it because there's an income side, there's an asset side, but the asset side is being calculated so you can affect the income side. So staying with 102 or starting with 102, if you could describe some of the major changes that are in 102, and maybe that means starting with student financial aid.
It is. It is. I'm telling you, like when I look at HOTMA and implementation notice, I'm like, oh, we can do this. There's some tweaks, there's some clarifications, there's some insight to help us understand other things. But man, this student financial aid or assistance, like it's really changed. And of all of the things in HOTMA, I would say that this change has the ability to be the most significant impact on household eligibility. And this has evolved over the last 20 or so years, how we treat student financial aid when an applicant attends a higher education is receiving some sort of student financial aid. And so of all the changes, while there are a lot, this is really the big one. It's, I think, the one my team and I were like, huh? To look at our internal working papers to figure out, how are we going to do this? Like, how do we streamline this in a way that makes sense? So for everyone out there, buckle up, because this is a new and exciting. I don't know if that's the word. I get excited when things are fun and I got to figure it out. But yeah, so student financial aid. The idea here is, and maybe we start with a little bit of history, right? And so if we think back to, it was the Appropriation Act, I think fiscal year 2006, which came out late 2005. And I don't know if anyone was doing this back then, but there was like there was a reason for that original change, but we won't. That's a podcast for another.
Okay.
But that's when we really started to have to consider if someone applies at a LIHTC property and they're receiving some sort of student financial assistance, do I need to recognize any of that financial aid as part of this household's total income? So a student is a part of a household, and we're looking at total household income to figure out if a household is income eligible for the program. And so what the rule was pre-HOTMA was that if I had a LIHTC applicant apply, and that LIHTC applicant was also a recipient of Section 8 rental assistance, that was really the only time that I would ask any additional questions about, hey, do you receive any financial aid? What is the cost of your tuition? And then go through a process and figure out anything that exceeds that would be considered income. And even then, it was under very limited circumstances. And so really for operationally, what we would do is if someone comes in and applies, says, yeah, I receive financial aid. First step is, do you have Section 8 rental assistance? And if the answer was no, I didn't met. It was completely excluded. That's changed. No longer is the case. In all aspects, when someone applies at a LIHTC project and they're a student of higher education and receiving financial assistance for that purpose, we are going to have to take steps to figure out how much of that, if any, needs to be counted towards that household's otherwise verified income for the total household income. And it can't just be as simple as, hey, you have student financial aid. Hey, this is the cost of tuition. We're just going to take the difference and move on. No. So really, we need to start with, I think, what is student financial assistance? And so part of what HOTMA does is that it expands the consideration of what I would screen for or ask someone if they have under various categories. And then once I do that, I have to figure out, does the source or the stream of student financial assistance fit into something under the Higher Education Act, or is it other? And that delineation has a huge impact on what I'm going to do next. And so the first thing I really want to highlight is that pre-HOTMA, we were looking at what I like to call free money. Like, so if you were getting like grants or scholarships in general were excluded because you were having to pay those back. Loans were in generally excluded. Well, not scholarships were excluded. Loans were excluded. But like things like grants that I didn't have to pay back, those were part of my universe of figuring out, do I need to count them? Now it's all the. And so if I have a loan under like a Perkins loan, that's all of a sudden something that I need to be aware of. So first step is changing what our understanding is of the world of what student financial aid is. Once we get through that, then we can categorize it correctly into either things, the Higher Education Act or other. Other could be stuff from like a local business that gives someone a grant or a scholarship or something from a nonprofit or something directly from the school. Those aren't directly tied to the higher education. And the delineation and the categorization of those two items is super key in how we're going to apply the next steps. All right, clear as mud so far?
Or just say you can err on the side of brevity, knowing that someone listening to this isn't going to, based upon this podcast, figure out how to do the calculation. But you framed it so far, it sounds like more student, when you look at the calculation of family income, or income will get included on average on this
Totally.
than before, correct?
That's an accurate state. More income is going to be included because we're looking at every student and not just limited to a certain subset.
So maybe as opposed to going down the detail of the calculation of financial aid, maybe we can direct folks to my article where we talk about a little bit more detail, and then direct them to other resources that we'll talk about later in the podcast. And then I feel like there's this overlay of the appropriations bills. And if you want to share how
Right.
that, sure.
Yeah. So the idea is that you're delineating between HEA and other financial assistance because anyone that comes in your door, what you're doing is assessing what's called covered costs for those applicants. And covered costs is very specifically defined in this context. And it includes pretty much everything. It's tuition, room, board, books, all those things, which is different than what it was before. So that's refreshing in the sense that we get to recognize more. And for the way that it works for any applicant is that anything in excess of, so first you take your covered costs and you remove HEA assistance, and that gives you your remainder. And then you take the other financial assistance and subtract out the remainder, and that gives you your income. And so when there is more HEA that covers your covered cost, where that remainder results in a negative number, then I'm using 0 as far as the difference, and I'm recognizing all other income. And so it does have an interplay a little bit to the extent that your HEA doesn't absorb all of your covered costs. And if it does, then you're looking at just your other income. The appropriation bill complicates this. So the language in the appropriation bill still lives there in the sense that we exclude various sources for the purposes of Section 8 households who are over the age of 23 with dependent children. And because we are doing that, the calculation is different when applicants have rental assistance.
And just at a really high level, we have up a final rule. It has all these various calculations. And then for Section 8 tenants, the appropriations bill has this additional overlay on the HOTMA regulations.
Yeah.
And basically have to continue to monitor whether or not the appropriation bill continues that overlay.
Yes, that's correct. And don't be scared, guys. Like I went back since 2006 to look at the appropriation bill, and it's been consistently in there. I don't anticipate it changing, but HUD does recognize it does change. Then hey, we're not going to do it this way. We're going to do it this other way. So be aware.
Okay, so we've let listeners know that there are notable changes to student financial aid. On average, more financial aid will be included than before. Turn to child support now. That part of the podcast, we discussed that as another area with offer as notable changes. If you could describe those changes.
Sure. So before, when it came to child support and alimony, we were including amounts that were anticipated to be received by the household. So said differently, if they had a court order and they could receive up to a certain amount, we only counted anything other than what was ordered in the event two conditions were met. First, they certified they weren't receiving the amount they were ordered. And second, that they could support and document they were taking all reasonable legal actions to collect it. So if I had a court order of $500, but I'm only getting $100 per month, unless I met those two conditions for the purposes of eligibility, the full $500 was included as income to my household. The change is now that instead of looking what's anticipated, it's what's actually received. And so we get to skip the steps of meeting those two criteria and focus solely on what an applicant is actually receiving in child support and alimony. In that same example, if they're actually receiving $100 a month, but the court order is $500, I'm now going to take $100 per month. And so we will be, in theory, counting less income when it relates to this particular source. And I got to tell you, like, in my experience in HFA and in my experience here, miscalculation of child support is probably one of the top 3 violations or issues that we tend to note, and that's across the country. And it's because of that weird having to meet the 2 criteria and all that. I imagine this is going to streamline it, which is perfect because it's the entire intent of HOTMA. It's to streamline and relieve unnecessary administrative burden. I also want to point out that not only are we looking for actual amounts received, the implementation even goes so far to say that if you get only a court order and you don't obtain documentation of actual amounts received, perhaps that's a payment history, that's not enough. You have not satisfied the burden of verification for that particular source. So it's a little bit of a change in the approach of what we're asking for as well, because normally our first ask is, hey, where's your court order? Give me your court order. And then I'm taking that and move on. So I really like this change, the student financial aid. I don't dislike it, but it is more steps. But this would make sense to me, right? Like, why aren't we just counting what someone receives instead of phantom income they could receive?
No, I totally agree with you. So the streamlining goal is wonderful, but it certainly seems like a more equitable goal for the
That makes sense.
goal that is not receiving the full amount of child support that they're entitled to receive. So we talked about student income from financial aid. We talked about child support. There are other changes effectuated by 102 that you want to point out for purposes of listenership and viewership?
I mean, there were a lot of changes. But these are probably the most significant ones that have a direct impact on someone's ability to qualify or not qualify. Some of the other changes really were more of like notes of clarification and not like super substantive. So they spoke to gig work, which is probably the first time anyone has publicly spoken to gig work in this context. They just said treat it like self-employment, which was, that's how we've been treating it. So thanks for that confirmation. So it was a little bit of that. It was like, hey, we realize this has been going on. This is what our expectation was. Small variances here and there, but like overall, these are the ones that I'm looking out for and I'm really honing.
Now, if you were to look at clients, the number and the various types of properties, and maybe taking seniors out, what percentage households very rough, and I hate to put you on the spot, but what percentage of households do you think are getting financial aid? What percentage of households do you think end up receiving some level of child support, just percentage wise?
Okay, financial aid, that's hard for me to ask because remember, up until now, it hasn't been part of my world
Right.
except for Section 8. So I actually don't know. Support, I'd say, you know, 75, 80%, if we're just focusing on family, like non-senior households. Yeah, a huge amount. And the issue with child support has always been there's not a consistent way nationally to verify it. Each state has their own enforcement entities. They have different ways that they communicate the information. They have different process for enforcement. So it's so frustrating to me because I could never say to any person, go get this one thing. This one thing will always work for you. Now I can't. But just go get the payment history and we're good.
So let's turn now to the imputation of income from assets. And this is section 104. My
I read a 104 on 102.
okay. So my big takeaway was that the number of applicants and tenants we're going to have to actually impute in the income is going to be less. And administratively, that'll obviously get easier. But if you could start by sharing how HOTMA changes the determination of the amount of assets taken into account, to unpack my foreshadowing of the net effect.
First, I do want to acknowledge you're right. You're exactly right in the sense that I don't see this particular change necessarily impacting eligibility, but it's substantive in the sense of what we need to do to figure out if it does.
Impacting eligibility or allowing more to those that are close to the income level to now qualify? Or do you think it's a practical matter? It's not that relevant for eligibility?
Well, I guess I'm saying impact eligibility up or down.
Okay.
Either which way. Yeah, I do think more people with a significant amount of assets will likely have more income from assets, but people with less total value of assets will have less income from the asset, which you would think does, Stephanie. Like, in fact, it's a higher amount, I'm going to have more, but it's not really about the higher amount. It's about how and where we're imputing income when it's unverifiable. So let's just break this down just a little bit. So the first thing we have to do is before assets were just assets, like except for just regular personal property, like the car I drive or the TV I have or my wedding ring, those were not assets for this purpose. So the first thing HOTMA does is it actually expands the world of what we consider to be an asset. And then that expansion further delineates between what's called non-necessary personal property and real property. And so we have to figure out, screen a household, do you have any of these sources? And once we screen them, separate them into the categories and figure out based on the categories, how did the total value of each category affect the other? So this is what I mean by that.
So categories are real property and then personal property, and then within personal property, necessary and non-necessary.
Yes. So we have real property, personal property, and then a subset of personal is non-necessary and necessary personal property. Necessary personal property, still going to exclude it. So my car, my wedding ring, still not going to be recognized. Now, however, non-necessary personal property, like all those boats our long-term tenants have, like those are all going to be assets now, and they're considered non-necessary personal property. Things like checking accounts, savings accounts, anything other than real property that's not necessary personal property is now recognized as non-necessary personal property. And this is super important because we exclude the value, just the value of the non-necessary personal property, unless the non-necessary personal property combined itself exceeds $50,000. That's an important kind of distinction because the next thing we're going to talk about is what is the trigger for imputing assets? And it's also 50,000, but it's 50,000 with a different definition and a different sum. So first we figure out non-necessary personal property. I like to think of this as like big E, little e, right? There's always big E exclude. There's always things I'm going to exclude. I'm never going to consider these. I'm never going to consider my car, never going to consider my TV, but not necessary personal property. It is included for the purposes of trying to calculate the total value of it. And it's always included for the purposes of any actual income that stems from that non-necessary personal property. But until the total value of that non-necessary property exceeds $50,000, I'm not actually it's just zero. All those values are zero. So it's like little e, I'm excluding it. And for us compliance folks, we tend to twinge a little bit. Like, what do you mean? Like, I verified a checking account. It's $100. I'm not going to put $100 on my income certification. No, because until that total non-necessary personal property exceeds 50,000, the value of it is zero, which is kind of good times, a little fun. Oh my goodness. One of my favorite things about the changes in HOTMA as it relates to assets, which is probably up in the other top 3 of issues that my team tends to identify, is retirement accounts are no longer considered assets. Big E exclude. And so we would oftentimes get folks like, oh, I have a 401k. They didn't disclose them on their application, but we see on the paycheck stuff. And we have to go through this like after figuring out, do they have access and all that stuff. Don't need to worry about that anymore. I'm like so excited about that. Child support and that I'll do with everything else HOTMA related because these make sense things. So anyway, back to the asset thing. So we have our non-necessary personal property and then we have our real property. The value of my real property is always included as an asset or recognized as an asset. So if I have land of $100 or land of $25,000, that's always going to be on my income certification and it's always going to have a value. But I'm not going to impute any income from assets for which there is an unverifiable stream of income until such time that the total value of my assets exceeds 50,000. And if you think about what that means is that I don't even recognize any non-necessary personal property until it hits 50,000. It's a huge stress of like limitations that we're dealing with. In the sense that until I hit 50,000 of my non-necessary and I have something with real property, I'm not imputing anything, which is way different than before. Because before, when the total value of the assets was exceeded $5,000, I imputed on the total value of the asset. So it's less for some and more for others, depending on the value of the asset.
Great. Thank you for that. Anything else you want to say on that, or should we move on to tenant verification?
No, I do want to say some more. I want to say some more about when we're imputing. A couple of other things that changed in the HOTMA is the passbook. So like for the longest time, up until I think it was like February of 2015, 2016, 2% was our passbook rate. Passbook rate represents HUD's interest rate by which we are imputing the value of the assets for the purposes of it. It changed to 0.06% in 2015, and it's been like that forever. For the first time, we have seen a change in the passbook rate to a whopping 0.4%. But guys, if you think about it, like that's pretty significantly higher than 0.06%. And so the passbook rate itself has changed, which means the interest rate I'm using to impute income is different. The other thing that's changed is that I'm not imputing income on the total value of the asset. I'm imputing income on each asset where there is not verifiable income. So if I have a checking account and I've crossed that threshold and I have to impute and I verified that interest rate is zero, no income. That's verifiably zero. But if I were to, like, say, have land and I don't have any verifiable income from it, then I would impute on that specific asset. So it's a shift in how we look at where and how we're imputing, in addition to at what level we are imputing assets.
Very good. Should we switch to verification?
Let's do it.
Okay, let's do it. So one area that I discussed in my call, in addition to what we've discussed so far, is how HOTMA changes property owners and managers verify income. So you can talk about some of those.
Sure. So for us that have been in this game for a hot minute, we know the HUD 4350 has always had like what's called the Appendix 3. And the Appendix 3 made sense for HUD programs, but as those HUD programs expanded, they made less sense for the application of the LIHTC program. So that's why we saw HFAs adopting their own verification standards, because it made sense for their portfolio, what their needs were. Appendix 3 was always a great jumping off point. We saw a lot of HFAs adopt Appendix 3 in part or its entirety, but it was a little outdated. Well, it was a lot outdated actually. And there's a lot of things that were embedded in Appendix 3 that just didn't make a lot of sense. So what HOTMA does in the implementation notice is it switches up into identify a verification hierarchy, which is pretty cool. And now has 6 different levels. And I'm just going to bum everyone out, let you know you can't get to level 6. We can't reach that level 6 of verification hierarchy because that's EIV or under HUD, the enterprise income verification system. And as LIHTC operators, we are prohibited from our eyes even looking at that. So we can never get to level 6. But level 5 is the LIHTC's world of upfront verification. So think about the work number or other web-based softwares that collect data as it relates to income, where you can pull it for tenant. And so what HUD does is it says, this is level 5. You can't get to level 6. So for you, everyone else who can't get to level 6, this is the highest level of verification. And I really like because it makes sense in today's world. And while HFAs still have control over how they want to see things verified, I think what the revised hierarchy does is gives HFAs an opportunity to review their policies and procedures in the reality of being 2024 in the current guidance and say, hey, what we're doing outdated? And so, for example, a lot of HFAs, and Mike, you're going to giggle at me, covet that third-party employment verification, because apparently people still have fax machines and they fax over to the employer the verification. They hold it in the highest regard. It's they need that. That's it. There's nothing else in this world that's going to verify employment. Well, the hierarchy says, nope, I'm going to supplant that to the third level of importance. There are level 4 and level 5 that you can get to have more meaning and more value as it relates to a verification than that kind of old school, I'm going to fax something to you, the employer is going to fill it out, and you're going to fax it back. So level 6 are things like web-based. Level 5 are tenant provide documentation. So these are things like paycheck stubs, bank statements, those have a higher value. And this is the first time I've seen that expressly stated by HUD. And so my hope are for those HFAs that are still coveting that third-party verification, that they'll be oh, maybe we should take a look at our policies and align more so with HUD. It's also helpful because of streamlining and verification across programs and our ability now to use other programs' verifications to satisfy the LIHTC certification. When we recognize this hierarchy, it gives us a level of comfortability that those other certifications were done in a compliant manner that makes us comfortable, right? And so there's a couple of really cool things in that verification hierarchy that I'm very excited about that I just want to touch on. So the first thing is that for checking account statements, right? Up until now, we've been required to get a 6-month value. And the reason why we had to get a 6-month value is because once upon a time we were writing checks. Do you guys remember? We had to write a check and mail it off to someone and then had to pass their bank and then had to go through our bank. And it's been a long time. And so we always got a 6-month average to figure out, okay, what things are outstanding? How do I really figure out an average with checks being cut and checks coming in? Well, that's real time now. And so there has been a significant switch to say, instead of using 6 months for checking account statements, our value is the most current checking account value. So I don't have to get 6 months of bank statements anymore. I can get the one, like I would a savings account, and move on. Love it. That makes a lot of sense to me. I'm getting a little bit of goosebumps thinking that I don't have to look at 6 months of checking accounts.
Yeah, me too.
The struggle is real, and folks on the listening will know what I'm talking about. The other thing is that they did change. So previously, if you were getting like tenant provided documentation, for example, paycheck stubs, for HUD, the requirement was 4 to 6 weeks. It's changed to 2 pay cycles. And so now it's just limiting to 2 pay cycles. Like, can I get 2 current paycheck stubs? And if I can, that from HUD's perspective is enough to capture and properly annualize out income. So that's less of a burden on administrators and it's less of a burden on the tenant. Oftentimes, I think we talk about these programs as programs and paperwork and tax records, but at the end of the day, it's someone's housing, right? And so the more sense we can make of it and the less burden we can put on our tenants, just the better overall the program function. And then the last thing I'll talk about that I'm like also super excited about is the idea that when the total household assets do not exceed $50,000, the household can self-certify to their values. So even then, I'm not having to obtain third-party or tenant-provided documentation to satisfy the verification requirement for assets. There are some kind of weird applications as this extends to the LIHTC program, and this is one of the spaces that HFA is going to need to weigh in on. But HUD does recognize that the self-certification of assets when they're less than $50,000 is sufficient. It holds the same weight as your traditional third-party or tenant-provided documentation.
Right. Thank you for that, Stephanie. All good insights on the verification. And I'm excited. Your enthusiasm is catchy. So when we were preparing for today's podcast, we discussed how the IRS has informally confirmed for us that when HUD changes their rules, then changes go immediately into effect for Section 42 purposes, for tax credit purposes. However, we also know that credit allocating agencies also will provide property compliance guidance to property owners. And sometimes their guidance is about their interpretation of rules. And then sometimes their guidance relates to additional property compliance rules that are unique to their state. As we know in the tax credit compliance world, you have to serve two government agencies. One is the federal government. You have to comply with all of the Section 42 rules. And then the state can overlay additional requirements, which we see obviously all the time to qualifying allocation plans and application commitments and things of that nature. So you have these two sets of rules you need to comply with. And as firsthand, there's often other financing involved, other support to a development that makes 3, 4, 5, 6, 7 sets of rules. And ultimately the property has to comply with each of these sets of rules. How are you seeing credit allocating agencies implementing the HOTMA changes, the HUD portion of the rules? Now they're working their way into credit allocating agency related guidance.
So first, I do just want to highlight the why behind, or reinforce rather the why. Remember that Treasury Regulation 1.42-5 directs HFAs on how we calculated income, but we have this other thing out there. It's the Guide to Completing IRS Form 8823. And while it in and of itself isn't authoritative, it's a collection of authoritative information. And in the introduction, it says very explicitly that if at any time the definition to income and asset changes by HUD, it changes for our programs automatically. That prior guidance becomes obsolete, and instead we simply replace the new guidance with the old guidance. And I think that's an important kind of takeaway when we talk about, well, why is this not in full swing for HUD programs, but it should be in full swing for the LIHTC programs? Remember, at the onset of this conversation, we talked about different branches of HUD. Each one of those branches have issues like notices for flexibility with compliance and monitoring specific to those various types of programs. But Treasury and the IRS haven't issued anything that would suggest that we have any flexibility or delay in implementing this. And as such, a technical interpretation is like, yeah, it's an effect. And so you're right, Mike, I have had some informal conversations with the IRS, and it was interesting because the conversations were almost like, I'm always hesitant after average income to ask the IRS anything, but also I felt like it was important because I wanted to know, hey, you guys going to come out with any guidance? Are you going to direct us to use this? And it was, what do you mean? Like, that changed, our stuff changes. And so from a technical IRS perspective for Section 42, this is in play. There is nothing that delays 24 CFR Part 5. There are things that delay flexibility for other programs related to HUD. And even those are not all the same across all the various programs. And so for us, I think we really need to be sensitive and aware of why is it different amongst states. I think I tend to categorize these in different avenues. First, HFAs that also are either like contract administrators or awardees or subrecipients of home funds or National Housing Trust funds, where they have other HUD streaming lines that they're required to make these changes. Those tend to be a little bit quicker to get on board. And even we were seeing as early as summer of 2023 training so that as of 1/1, it was a go. For those HFAs who are just like credit allocators, those tend to be the ones that we haven't seen full implementation yet. And that it's really more about them trying to understand how they should be incorporating this into their process. For me, I think we should all be doing this. So I don't see where the gray area is, but compliance has always been about understanding the black and white and then figuring out how to operate in the gray. I feel like that should be my catchphrase because I say it quite often. But yeah, so HFAs they have control over their program, and we need to remember that. And that's not unusual to HOTMA changes. That's pretty much how it always has worked. And so checking with your HFA to figure out, have they implemented it now? Are they interpreting any of these things a little bit different? So for example, the ability to self-certify to assets when they're less than $50,000. There are HFAs out there that tend to think that we can't do that for the LIHTC program because of Revenue Procedure 9465. It only allows us to self-certify when the assets are less than $5,000. But it's a bit of a circular argument because at the time that revenue procedure was written, the only imputed income limitation was $5,000. Since that has inherently changed, by extension, our processes should change. So that's an example of an interpretation where we may see some difference. Another different kind of interpretation that I'm seeing out there, and really I've only identified one state that does this, but it's the second largest allocating agency in the country. So we should probably be aware that maybe other folks could follow suit. This idea that they're not worried for financial student assistance, they're not taking into consideration if someone receives Section 8. They're interpreting HOTMA to say, you know what? That's what Section 8 needs to be doing. They need to be figuring out if someone's applying for multifamily housing or public housing or Section 8, how to figure it out. We're not a Section 8 program, and therefore, for our programs, we're just going to treat everyone in one way. And we're not going to worry about the streamline of programs otherwise. And so those are examples of interpretations that I've seen that are different than I would maybe interpret.
Great. Thank you for that. There's lots to sort of unpack there at the credit allocated agency level and the overlay with the HOTMA changes. So
I don't know what the holdup is. HOTMA's like so much easier. Listen, quote me on it or not, but like I actually think this makes complete sense. As an HFA, I would totally want to get on board sooner rather than later.
Exactly.
So I struggle to understand what the holdup is.
So thank you for that, Stephanie. And I would note to our listeners and viewers, I mentioned earlier my article in the Journal of Tax Credits. There's also Stephanie's article. And if you're looking for additional resources, please join us at our Affordable Housing Conference in San Francisco on May 2nd, 3rd. Also, there'll be an upcoming webinar that Stephanie will be the central guest on discussing these changes. And there is a webinar that we did at the end of last year in anticipation of the HOTMA changes becoming effective. And then as always, I'll include my guests' contact information in the show notes. I'd encourage you to reach out to Stephanie for more guidance here, as well as ensuring if you're not a property manager, if you're an owner, have your property managers reach out to Stephanie to get more guidance. Because at the end of the day, this is all about ensuring that you're tenants are qualified tenants, such that you're eligible for tax credits on those units, as well as ensure that you're calculating income well or correctly. And in many situations, under these rules, the income will be slightly less, and there might be some tenants that in the past, prospective tenants that weren't eligible that now will be eligible. And Stephanie, let me say thank you for being a guest on Tax Credit Tuesday. I'm going to skip our off mic section. We have so much to talk about in terms of property compliance, and it's so detailed that the podcast is running a bit long. So I'll save the off mic questions for your next visit on Tax Credit Tuesday, which may be sooner than we'd otherwise expect as the HOTMA changes get more attention. And as I noted, once again, I will include links to all the items that we discussed through the podcast. And before I sign off, I just want to remind everyone to subscribe to our podcast on whatever platform you use, to listen to or watch it so you don't miss an episode. So thank you again, Stephanie. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.